Hello, welcome back to class. This is the fifth module of Advanced Financial Accounting, and we are looking at revenue recognition and contract accounting. Revenue recognition and contract accounting. We will look at revenue recognition principle, identification of contracts and performance, obligation, measurement of transaction price, allocation of revenue, contract assets and liability, long-term and construction contracts, and lastly IFRS 15 and ASC 606 comparison. Revenue is a critical measure of financial performance and a key focus in financial reporting, and the IFRS 15 and ASC 606 provides a single comprehensive framework for revenue recognition across all industries, and the 5-step model ensures revenue is recognized when control of goods or services transfer to the customer. And this model covers principles, application, and differences between IFRS 15 and ASC 606. Let's look at the 5-step model under IFRS 15. The core principle is applied through 5 systematic steps. The first is identifying of contracts with a customer. The second is identifying performance obligation within the contract. The third is determining the transaction price. The fourth step is allocation of the transaction price to performance obligation, and lastly, recognition of revenue when or as each performance obligation is satisfied. Let's look at step 1, identifying of contract. Identify the contract. A contract exists when all 5 criteria below have been met. The first is parties have approved and are committed to the contract. Rights and payment terms are identifiable. The contract has commercial substance. Collectibility of considerations is probable, and this is actually greater than 50% under IFRS. And contracts may be combined if negotiated as a package. For the step 2, identifying performance obligation. A performance obligation is a promise to transfer a distinct good or service, and a good or service is distinct if 1, the customer can benefit from it on its own or with readily available resources. 2, if it is separately identifiable within the contract, and a series of similar services with the same pattern of transfer may be treated as one performance obligation. The third aspect, which is determining the transaction price. The transaction price is the amount the entity expects to be entitled to, excluding amount collected for third party. And you need to consider the variable consideration, as per example of bonuses, discounts, estimates using expected value or most likely amount. Also, you need to consider the constraints, which include only if highly probable that no significant revenue reversal will occur. And the last is significant financial components, that is, you adjust if payment timing provides a financial benefit. The fourth step is the allocation of the transaction price, and allocation of transaction price is based on relative stand-alone selling price, and if the SSP is not observable, estimate using 1, adjusted market assessment, 2, expected cost plus margin, and lastly the residual approach if criteria met. And discounts and variable considerations may be allocated to specific performance obligation. if conditions are met. And lastly, which is the fifth step, is the recognition of revenue. And revenue is recognized when control transfer over time. If one customer simultaneously receive and consume benefits, asset is controlled by customer has created, and lastly, no alternative use plus enforceable rights to payment. And at this point in time, if not over time, based on indicators like transfer of title, possession, risk, and reward. Looking at contract asset and liability, when we talk about contract assets, this is actually a right to consideration conditional on future performance. Example is work completed but not yet billed. And we have contract liability also, which is an obligation to transfer goods or services after receiving payment, which is also the deferred revenue. And for receivables, it's actually a right to payment unconditional except for passage of time. Let's look at the key differences in the IFRS 15 versus ASC 606. And for this, the first difference we'll be looking at is the collectibility threshold. And for IFRS, it uses probable, which is greater than 50%, and for GAAP, it often interprets as higher. As per impairment of contract costs, different impairment model under IAS 36 versus ASC 606 guidance. And for disclosure requirement, ASC 606 requires more detailed interim disclosure, and under licensing guidance, ASC 606 provides more detailed implementation examples. In conclusion, IFRS 15 provides a principle-based 5-step framework for consistent revenue recognition, and proper application requires judgment in identifying obligations, estimating price, and determining timing of recognition. Having a mastery of IFRS 15 is actually essential for accurate financial reporting and compliance across industries. And the understanding of the difference with ASC 606 is crucial for entities reporting under both framework. Thank you.